Okay, I've been a little bit lax in some of the very, very update videos. I mean, after a year of it, seems like the rate changing all the time. Obviously, we have March rate hike, which was the last video where there was no rate hike. We finally had static payments. Rates have not changed, and they're predicted to go that route for this year. But hey, what a few weeks that we've had, and we want to talk about how this impacts your interest rate because we are going to see some meaningful changes. So, first of all, there's a few things in the news that you may know and a few things that you may not know, but all these are going to be very, very important. So, um, we know that just a couple weeks ago, depending on when you're watching this video, of course, it was in the news Silicon Valley Bank having to be shut down by the regulators. Why does this happen? What does it have to do with your variable rate mortgage? I'm going to break all that down for you. So, what happened is that during the uh, times of low rates, there can be some impact on the bank's balance sheet. So let me explain this. So what we have here is that there is something in the United States where they have some banks that are fractional reserves or no reserve banks. So what does that mean? That means if I take $10 into a bank, uh, you would think the bank has to keep that $10 on hand in case I need to have the $10 back. I took $10 in for savings, but what if I want to go buy my new house or whatever it is? I got to have that available. And so the typical thing is that there's different reserves for borrowing money and depositing money, but in the United States you have a significant amount of banks that are fractional reserves or no reserves. So what does that mean? That means if I bring $10 in, they might have a situation where they only have to take $2 on hand, or they might have to not keep any of it all. What do they do with that? Well, they're going to take that money they bring in and they're going to reinvest it out, buy assets. In this case, what we see a lot of these banks did was buy bonds. Now, what's happened is that as interest rates have moved up, those bonds that were really, really cheap have now become more expensive, meaning that these are not very profitable and they require some retweaking and recalibrating of a balance sheet for banks. And so that results in them being in a pretty bad spot, which means what really got created in the Silicon Valley situation creates what's called a bank run. What is a bank run? A bank run means what happens if everybody decides today I need my money. I need my money. I got to get my money out of here, and they don't have enough. That's what happened. As bonds go up, and creating all that type of drama and changing things in the balance sheet. And we have a bank run, people run in, not enough money. SEC, Securities Exchange Commission, has to shut that down. Now, we don't have really fractional reserve banks in Canada, so we're not quite as close to that as some think. Now, here's the other statistic that very, very important on this. When you have and you saw President Biden go on the news and talk about this. What is when you have a situation where a bank shuts down, what is the protection for a consumer? And so you'll know that in the United States anyway, $250,000 protected in case a bank shuts down, deposits by the government. Now, at the Silicon Valley Bank situation, 90% of depositors were not protected. What does that mean? It means 90% of depositors have more than $250,000 in the bank. And so that puts a point you need to know. We're talking about wealthy venture capitalist funds, wealthy startups. We're talking about sure, not everybody is doing great on that, but it means we're talking about high net worth individuals being put out by that situation. And so not mom and pop or people that have their life savings that have worked, moderate incomes their entire life. So 90% of folks when it comes to that situation. Now, the first point I want to put as an Easter egg in this video is that you need to know that it is not a great strategy to keep all your money in one bank. I would say that number is 100,000 even in Canada. So don't keep more than $100,000 in one bank. Spread it out to other banks. I keep money in savings in the United States, other accounts, not like weird offshore accounts type of things, but this is important because you do run a risk that you have some money that's uninsured. There's money that will not come back on that situation, and so that's important to know. So in Canada, we obviously require some pretty substantial reserves, so that becomes more unlikely, and we just don't have as many unregulated bank situations from that perspective, and we have banks with stronger balance sheets. So, they have more money and all type of thing. We have the big five and, some other smaller situations from that perspective. Okay, well, let's circle this back around. Well, that's all great information. Thanks, Joel, for sharing that with me. But what does it have to do with my variable rate and my fixed rate mortgage? The cost of bonds. The cost of bonds is what influences and changes the price of a fixed rate mortgage. As those bond yields change, as they have this week, that we plunge fixed rates down. We're already seeing that. The fixed rates have started to plunge down over the last 48 hours, and we're expecting to see that into next week as the cost of bonds goes down. Now, could it rebound? Sure. There is some, it doesn't mean it could be temporary. There could not be an opportunity there, but it goes to show, one, is that interest rates can change on a dime based on some event, and we need to always keep that in mind as well. But the other thing I want you to be really aware of when it comes to that, and then I'm going to get to a couple of action points here, is that I've talked about all the time when it comes to the Bank of Canada changing rates. You have to remember the Bank of Canada changing rates doesn't just impact you and your variable rate. You're thinking about your micro situation, my variable rate, my line of credit, where we don't often realize of the true massive amount of people being affected by rate change and how that can massively cause a ripple in the financial system. So rates going up caused that. It doesn't mean that it's the true cause. It means it exposed vulnerabilities in the balance sheet of a bank, but that's the result of that. So as rates go up, this has now caused a situation where, from the fixed rate perspective, rates will go back. That rates have already gone down and looking to go down further. So that's the one portion of it. We also have to look at completely a separate situation, the inverted yield curve. And so the inverted yield curve, which shows us the spread between different terms of the return on different two-year bonds, 10-year bonds, that is the most inverted. So just basically means that your return is going the wrong way. Rather than getting the weeds on it, is that it's the most inverted that it's been since 1981, and it was inverted like that when you hear people talking about 20% interest rates, all type of things. We are at the exact same inversion on the yield curve than we had at that time, and so this means that we know a few things. Wrapping this up, we know a few things. We know that a recession is very inevitable. A recession will cause that prime rate at some time to go down, and it could possibly make it go down very quick. We are not thinking enough about the fact that if interest rates are moved up as a result of inflation, and inflation as a result of, during the height of COVID, 90% supply chain issues, and during the last while, about 60% supply issues, that if those are rectified, supply chain issues rectified, which they appear to be, that we can have inflation really plummet very quickly. It has decreased for the last 7 months, and so this is quite a possibility. We add into all of these things going up that we have the bonds changing price, fixed rates moving down, and we have some very scary economic activity. I would say that we have a pretty likely chance that, as we've thought all along, that this is going to cause the prime rate at some point to go down. Canada on the financial system has a lot more stability on some of those things, so it would take them longer to move it one way or the other. But this is something to be watching. So a few things I want you to be aware of. If you are in the fixed rate camp, your time is to this is your best time to get into a fixed rate over, probably not right this second, but you should start getting in the process. So if you're thinking about buying a home, now is the time to engage us. If you know someone that's looking to buy a home that's on the fence, now is the time to engage us on that type of thing, because we're going to see fixed rates probably even into next week go a little bit lower. If you have a mortgage and the rate is higher, we need to run those numbers. We've had a limited people call out. We need to run those numbers. And remember, when running those numbers, it's not just about, you have to look at, people say, it doesn't make sense. These are the two things that make sense on. First, run the numbers as if, will I save more interest paying out my mortgage early? And will the penalty it costs me to pay out, will that better? That's one way of looking at it. So I'm going to pay my mortgage off quicker because I'm paying less interest. Two, can I get a lower payment? Lots of times we run these numbers of the payments, once we have the penalty in, it's very similar, breaking the mortgage early. But is that lower payment meaningful? If I drop down by $300, will $300 on my monthly budget making meaningful difference on what I'm doing on an ongoing basis? And even though it breaks even, I should take that, because $300 on a monthly basis makes sense. Or $300 reallocated. I'm taking $300 and reinvesting it. That makes sense at all. Think about those scenarios, and it makes sense to redo your mortgage, re-up your mortgage. Now is that time and that window to do it. I do think that if you are a variable rate holder, I do think that there is relief coming. I don't think that's probably in April or May, but I think we got into the summer, and we really did think it would be a whole year. We're going to see some activity. Now, of course, there could be some stimulus that happens, or there could be some writing of the course really quickly. I mean, there is no guarantees on this, but this is something to pay attention to, that variable rate could be moving down further. Now, if I'm really struggling on the variable rate because of how high it's went, another thing I could look at is I could be moving that over to a fixed rate that's going to meaningfully change my payment. But I'm gonna be hamstrung going forward on it. So anyway, lots of information on that video. Wanted to get that out to you. If you need help with a mortgage, if you know someone's going to be buying a home in the next 6 months, get them to get in touch with us. If you know someone's coming up for renewal, get them to get in touch with us. It's never ever been a case like we have right now where banks are not being all that competitive. Get them to get in touch with us. If you know someone's talking about having a lot of debt, doing a reno, please let's pass them on our name. Let us get in touch. If you are thinking about those things, even if we had already the conversation, sometimes what happens is that people speak, especially to me, and we'll talk about different scenarios. Let's circle back. Let's circle back and talk about different things, different options, even if you've been offered other things for different places, come back for a second opinion, all those things. So if this can help anybody, please do share this video with as many people as you know. And please take the time, if you haven't subscribed to our video updates, subscribe to our YouTube channel. That really helps out as well. Have a great day.